Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Last video I have explained you about the meaning of the term capital gain and what are the conditions to be fulfilled in order to treat an income as capital gain. And what do you mean by capital asset? The different types of assets we have discussed about tangible assets, intangible assets, non-financial assets, financial assets. All these things I have explained in the last video. Hope my regular viewers have already watched that video. If you have not watched, go to the playlist of my channel. Select the subject income tax for the assessment year 21-22. Select the video of capital gain. Because if you are thorough on theory, easily you can do the problem. Otherwise, every problem will be a difficult one. All the problems are based on the provisions which I am explaining here. So in this video, I am going to continue with the explanation of capital gain regarding the taxability of capital gain. How income tax will be applied on different types of capital gains. And then I'm going to explain you about the special note and also about the transfer of an asset, when an asset is transferred. So before starting this explanation of this video, take a screenshot of the points which I have written, then I'll explain. Now, taxability of capital gain. We have two types of capital gain, long-term capital gain and short-term capital gain. Different rates of tax are applied on long-term and short-term. So, taxability of capital gain, category A. Category A will take non-financial assets and category B financial assets. For non-financial assets like land, building, machinery, or example, jewelry, gold ornaments, all these are called non-financial assets. So for non-financial assets, what is the explanation? Land and building. If land and building or both is held by the SSC for a period of less than or equal to 2 years, 2 years means 24 months, then it is considered as STCG, short-term capital gain. And if it is held for more than 2 years, it is considered as long-term capital gain. First point, you have to remember, if the non-financial asset consists of land and building, the period of holding is 2 years. If the asset is held for less than 2 years or up to 2 years, the asset will be called short-term capital asset. And if it is transferred, short-term capital gain. If the holding period is more than 2 years, holding period is more than 2 years, then it will be considered as long-term capital asset. And the gain arising will be known as long-term capital gain. That's it. This is for land and building. Now, other non-financial assets other than land and building, leaving the land and building, all other non-financial assets, the holding period is 3 years. If the asset is held for 3 years or less than 3 years, it will be called short-term capital asset. If the asset is held for more than 3 years, it will be called long-term capital asset. Simple. Non-financial assets, land and building 2 years, and other non-financial assets 3 years. That's it. Now, category B, financial assets. For the sake of understanding, we divide the financial assets into 3 categories. That is BA, BB, and BC. So what are the assets that will come under BA? Securities listed in a recognized stock exchange. Any security which is listed in a recognized stock exchange. Secondly, units of equity oriented of UTI or mutual fund. Any units of UTI or any other mutual funds. Then third one, zero coupon bonds. So these 3 assets will come under BA. Now category BB, unlisted shares. Unlisted shares, only one item will come under B category. C category, units of debt oriented funds, unlisted security other than shares, other non-financial assets. So we have categorized the financial assets into A, B, C. Under A we have taken 3. Securities listed in stock exchange, equity oriented units of UTI and zero coupon bond. 3 items are there in A. B item, only one unsecured share, unlisted shares. Unlisted shares. And C category we have 3 units of debt oriented funds, unlisted securities other than shares, and any other non-financial asset. That's all. Now category B. Actually it is any other financial asset. I'll write down any other financial asset, which is not non-financial, it is financial. Now category B, A. For category A, 3 assets are there. What is the rule here? If held by the SSC for a period of less than or equal to 1 year, then short-term capital gain. More than 1 year, long-term capital gain. That's it. So for first A category, 3 assets are given. For these 3 assets, the period of holding is 1 year. If the asset is held for 1 year or less, it will be called short term. If the asset is held for more than 1 year, it will be called long term. For these 3 categories, right? Now B category. B category, what we are having? Unlisted shares. For unlisted shares, if held by the SSC for a period of less than 2 years or equal to 2 years, short term capital. For more than 2 years, long term capital. So here it is 1 year. For B, it is 2 years, and for C, it is 3 years. So if held by the SSC for less than or equal to 3 years, short term, more than 3 years, long term, for C category. That's all. These are the rules you have to remember. In the problem, it will not be specified whether it is short term or long term. If you remember these provisions, then you can decide the capital gain will be short term capital gain or long term capital gain. That's it. Now one note you have to remember, the period of holding is counted from the date of purchase to the date of transfer. In all these cases, we have to see what is the holding period. The holding period consists of the date when the asset is purchased and the date when the asset is sold. That's it. Now on special note, 2 special notes I have given that you have to remember while doing the problem. Will come across this point. So remember carefully what are the provisions. First, if the listed equity shares give concentration on wording which I am explaining, these are the provisions of Income Tax Act 1961. First one, if the listed shares or equity oriented units of mutual fund, 2 items. If the listed shares or equity oriented units of mutual fund are transferred through recognized stock exchange or on which STT is paid. STT stands for Security Transaction Tax. In India, whenever a security is transferred in a stock exchange, at that time STT will apply. Security Transaction Tax will be applied on those transfers which are taking place in a stock exchange. So here, any listed shares or equity oriented units of mutual fund are transferred in a recognized stock exchange on which STT is paid. In that case, the long-term capital gain is exempted up to rupees 1 lakh. And over 1 lakh rupees long-term gain is taxable at the rate of 10% flat without availing the benefit of indexation. What is indexation? Next video I am going to explain. Right now remember the point. Very important point. In the coming problem you will come across this point. What is the point? If the listed shares or the units of equity oriented units of mutual fund or any mutual fund is transferred during the year in a recognized stock exchange on which STT is paid, Security Transaction Tax is paid, it is exempted up to rupees 1 lakh, and over 1 lakh rupees capital gain is taxed at a flat rate of 10% without giving the benefit of indexation. That's it. Now second note, if the shares are not transferred in a stock exchange, that means shares are transferred privately. Shares are transferred privately. That means no STT is paid. Security Transaction Tax is not paid. In that case, the law is different. What the Income Tax Act says, if the listed shares or equity oriented units of mutual fund are transferred privately or in an unrecognized stock exchange, STT is not paid. The SSC has to pay the tax on LTCG. So what is the second case? If the shares or equity oriented units of mutual fund are transferred privately, here it is not privately, here it is in recognized stock exchange. Here it is transferred privately or unrecognized stock exchange on which STT is not paid. In that case, the SSC is taxed LTCG. How much is the rate of tax? Here it is given. However, the SSC is given an option to pay 20% with indexation or 10% without indexation, availing the benefit indexation. That is the minimum of the above two is tax liability. In this case, the SSC is given two options. One option, 20% tax on LTCG, 20% of tax on LTCG with indexation. In the next video, I'll discuss about indexation. 20% with indexation or 10% without indexation. Whichever is lower, that will be the tax liability. Suppose if you have transferred the shares. If you have transferred the shares privately or in an unrecognized stock exchange, no STT was paid. Income Tax Act has given an option to you. Pay 20% tax with indexation or pay 10% tax without indexation. So we calculate what is the tax with indexation, what is the tax without indexation. Whichever is lower, that will be the tax liability. These are the provisions. Very important. Now, advance money received and forfeited. Sometimes in a sale transaction, the seller will take some advance money from the buyer and given a period that within this period you have to complete the sale by paying the amount. Suppose if the buyer fails to pay the amount during that period, the seller will forfeit whatever the amount paid by the seller. Example, Mr. X is the owner of the building. He made an agreement to sell this building to Mr. Y for an amount of rupees 50 lakh. Now agreement says at the time of signing the agreement 1 lakh rupees should be paid by Y to X and the sale deed should be completed within 3 months. So 3 months time period is given by X to Y. Within 3 months you pay the remaining amount and take the delivery, take the house. That is the agreement. But if you do not pay the amount within 3 months, then whatever advance money you have paid, that will not be refunded. That is called forfeiture. Then what the law says, if the forfeiture amount is done before 1/4/2014, if the forfeiture is done before 1/4/2014, then this forfeited amount is taxable under income from other sources. Mr. X has forfeited 1 lakh rupees from Mr. Y. This 1 lakh rupees forfeited is taxable in the hands of Mr. X under the head income from other sources. However, if the forfeited amount is received before 1/4/2014, then this forfeited amount will be deducted from the cost of acquisition. From the cost of acquisition. This is the rule regarding amount received as advance and forfeited. Next comes transfer of capital asset. In examination, a theory question will be asked. Explain the provisions regarding transfer of capital asset. Income from capital gain is charged only when there is a transfer of capital asset. So what is transfer? Income Tax Act has not clearly given that this denotes transfer. It has given only an inclusive definition. Inclusive definition says transfer includes the following. That means apart from this, any other item may also be treated as transfer. So what are the items that will come under transfer? First one is sale. This is the common method of transfer. Sale is a transaction in which the capital asset will be sold by one person to another person. So there is a seller and a buyer. So in this buy and sell transaction, there is a transfer. There is a transfer. Example, Mr. X sold property to Mr. Y for rupees 50 lakh. So Mr. X has given the property to Mr. Y and Mr. Y has paid the amount of 50 lakh to Mr. X. That's a sale. That's a common method of transfer. Secondly, exchange. There is a barter system. Goods exchanged for goods without money. Example, a person has transferred his house to a company, sold his house to a company for rupees 80 lakh. The company has not paid the cash. The company has given shares. For example, I am having a property in my own ownership. I am the owner of the property. 80 lakh rupees is the value. I sold this 80 lakh worth of property to a company. The company had given me 80 lakh rupees worth of shares. It's an exchange. No money. I have given the property and he has given the shares. Exchange. That will also be considered as transfer. So any gain arising from exchange is a capital gain. That's it. Third one, relinquishment. Voluntarily transferring the property by one person to another person. Voluntarily. Example, in the case of a partnership. A partner voluntarily has transferred his property in the name of the firm. In the name of the partnership firm. Without any compulsion. So on his own, voluntarily he has transferred. That is called relinquishment. So relinquishment is also one of the method of transfer. Next, fourth one is extinguishment. The transfer compulsorily takes place according to law. According to the provision of law, the ownership will be transferred compulsorily. That is called extinguishment. Example, when a fire occurred, the insurance company will pay the amount to the insured and take the charge of the destroyed assets. Some of the assets are destroyed, partly damaged, partly not damaged. So the ownership of these destroyed assets will be transferred to the insurance company as soon as the insurance contract is completed. Compulsorily the ownership is transferred to the insurance company. That is called extinguishment. Compulsory acquisition. In some cases, the government will compulsorily acquire the property of the SSC. For example, the government wants to lay the railway line, or the government wants to make master planning. In that case, compulsorily the government is acquiring the land and building of the SSC. Income Tax Act says that is also a transfer. Any gain arising on that transfer is also taxable. Next one, conversion of capital asset into stock in trade. Sometimes an SSC will convert his capital asset into stock in trade. That will also amount to transfer. Example, during the year 2010, a person has purchased 10 lakh rupees worth of gold for his own purpose, for his investment purpose. So he has purchased the gold for his personal use. So personal use, he has purchased the gold. It's a capital asset. Later on in 2015, he has started a business of gold, purchasing the gold and selling the gold. In that case, he has converted his 10 lakh rupees worth of gold purchased earlier into his shop. Then earlier it is a capital asset. Now it will become a revenue asset because he has kept that gold for sale purpose. This is called conversion of capital asset into stock in trade. Capital asset into stock in trade. So any gain arising on transfer of capital asset into stock in trade is a transfer. Example, at the time of purchasing the gold in 2010, the value of the gold was 10 lakh. And at the time of converting that gold into stock in trade, the value of the gold was 15 lakh. Just 5 lakh rupees value of gold has increased. Income Tax Act says this 5 lakh rupees is a capital gain. He has to pay the tax because he has converted the capital asset into stock in trade. So I have explained all these 6 points. These are the provisions of Income Tax Act regarding transfer of capital asset. It will be asked in theory question. Next one is capital gain. What is capital gain? The gain arising on the transfer of capital asset during the previous year is called capital gain. Now, how to find out the capital gain? Selling price of the asset minus cost price of the asset. Selling price of the asset 15 lakh, cost price of the asset 10 lakh. So 15 lakh minus 10 lakh, 5 lakh rupees is the capital gain. Sometimes there is a capital loss. The sale price is 10 lakh, whereas cost price is 15 lakh. So 10 lakh minus 15 lakh, you will get minus 5 lakh. That's a capital loss. So we may get capital gain or we may incur capital loss. Last one. If transfer expenses, example selling expenses or brokerage are paid, then the same can be deducted from the sale money received. Sometimes in order to sell the asset, the SSC has incurred some brokerage, some selling expenses. That brokerage or selling expenses can be deducted from the consideration received. Example, Mr. X sold his residential house for rupees 50 lakh. 50 lakh rupees is the sale price at which the property is sold. But in order to sell this property, he has appointed one broker. And he told to the broker that he will pay 10% as commission. 10% as commission. So 50 lakh rupees is the consideration received, out of which 5 lakh rupees are the brokerage payable. So 50 lakh minus 5 lakh, 45 lakh rupees is the net consideration. That's all. So in this video, I have explained you about the taxation on different types of assets, non-financial assets and financial assets. What is the duration, time period, when it will be called long term and when it will be called short term. That I have explained. Apart from that, some special note, 2 special notes I have explained. Right? Last one is transfer of asset. When transfer of asset will occur. And lastly, when capital gain will arise. So inshallah we'll continue the next topic in the next video. Remember, this theory is very, very important from even examination point of view also.